Well, today we have a very special guest in the show, Mr. Rick Rule. How are you doing today, sir?
I'm doing well. The better for being on with you. Thank you.
We appreciate it, Rick. Well, Rick, you are very quite known in the natural resources investing world, but I would like to spend the first minutes knowing Rick Rule a little bit more. The following questions that I took from the Rule classroom is quite appropriate to start our conversation in natural resources. What it is about yourself, Rick, that makes you the right choice to answer the questions on hand regarding natural resources and commodity investing?
Well, I think first of all, Javier, I've passed the test of time. I've been doing this now for almost 50 years. Many people in their career flit, if you will, from avocation to avocation, never spending enough time to develop expertise in anything. Malcolm Gladwell has suggested that it requires 10,000 hours of concerted work to be able to be considered an expert in something. There is also the popularly held dictum that somebody worked 10 years to be an overnight success. If that's true, I'm 5 overnight successes. I've done one thing basically for 50 years. And I need to say, I've made a lot of mistakes, which I've generally tried to catalog for people when they ask me. But I've been part of building a couple pretty good size natural resource companies. Most lately, Sprott, which is now almost US $30 billion asset manager in precious metals and natural resources. So I hope that answers the question. I've stood the test of time.
Yes, it does. And let's start for the big macro picture following your expertise on natural resources. Why or why not should listeners pay attention to commodities right now? Do you believe all commodities have some sort of correlation and move up and down together in a cycle? Can walk us through some of the fundamentals of the broad natural resources and where are we now?
I believe that you have a system of cycles, which is to say that not all natural resources act in concert. There are broad forces that impact all natural resources. One would be the business cycle, but of course, the business cycle isn't correlated around the world. One country may be doing well while another country does poorly. There is also, of course, the interest rate cycle. These are capital-intensive cyclical businesses. And if capital is expensive, these businesses do poorly. What's unique, maybe not unique, but what's important for investors to realize about every natural resource segment is that they are capital intensive and they are cyclical, which means that the way that you invest in them is different than the way that you might invest in banks or retail businesses. You have to be a contrarian to exist in the natural resource business. If you aren't, you are going to be a victim. In natural resources, the cure for low prices is low prices. The cure for high prices is high prices. So you have to have the courage and the foresight to invest in these businesses countercyclically. That's very different than many other forms of investing.
Great. And to be countercyclical, you have to analyze the natural resources as a whole and then try to figure out which commodity is the one that is going to do well over the next term. What I would like to do is cover briefly 5 specific commodities. And for each of them, maybe you can tell us some highlight, maybe some catalyst that people need to know about each of them that you think is very relevant for listeners to know. Maybe we can start with uranium. You've been a big advocate for the last years in uranium. Now is very hot topic, one overnight success, as you said. The price has gone from $20 to $100. Do you believe the price has legs to run? And which catalyst do you see in the future?
That's almost a trick question. Yes, the price could run, but no, it doesn't have to run. What has to happen is that more of the forward volume in the uranium business needs to be transacted in the term market so that there is price certainty for the producers.
Mhm.
It's important to note that despite the fact that the uranium price in the spot market has run from 20 US dollars per pound to 100 US dollars per pound, and while 100 US dollars per pound is certainly a sufficient price to incent new production, you can't just flip a switch. You have to, in certain cases, find these mines, permit these mines, which by itself can be a 20-year process,
Mhm.
finance these mines, and build these mines. In the near term, the only real production increases that I see
Mhm.
are at Kazatomprom and Cameco. And both of these companies have said that they won't bring the mothballed production back online until they have contracted enough of that production into the term market so that their shareholders can be assured of a reasonable return on capital employed. I think this is probably happening very quickly now,
Mhm.
but the fact that I think it is true doesn't make it true. You are going to have to wait to see restart announcements from the company. But at any rate, you are talking about a supply deficit in the range of 50 million pounds a year, and you are talking about returning between 25 and 35 million pounds a year in production. On top of that, Javier, you need to pay attention to the fact that there are 68 nuclear plants worldwide under construction.
Mhm.
And depending on who's counting, another 110 to 150 in various stages of proposal, permitting, and financing.
Mhm.
So this discrepancy between the production deficit and production will keep growing in the out years. The
Mhm.
key really is going to be the development of the term market, and that's where the future is determined. I need to say to your
Mhm.
listeners that the easy money in uranium has been made.
Yeah.
The easy money in uranium was made in 2022 when the price was at $20 and nobody wanted to buy it.
Mhm.
The easy money is made when a commodity goes from being hated to being of interest or even being loved. I'm reasonably convinced, but not certain, that the sure money, perhaps even the big money, is ahead of us.
Mhm.
But it'll require work. You're going to have to analyze these term contracts, which aren't currently disclosed publicly. It's going to be a lot of work. You're going to have to look at, as an example, feasibility studies around NextGen. You're going to have to look at financing terms. You're going to have to look at what percentage of the future production has been contracted to who.
Mhm.
Are they investment grade counterparties? And what are the terms? So we're getting down to the hard work now.
Okay, yeah, that's something that listeners have to pay attention a lot to the term market, which is not public. We see the $100 term in the spot, so things are quite attractive there in the uranium space. Second metal that I want to focus on a little bit is gold. Gold hasn't done anything pretty much for the last 4 years. It's been in the 2000s price mark for the last 4 years. Do you believe cutting interest rates is going to be a catalyst? Are we closer of going back to the 1,000 level mark, or are we closer to breaking out from the 2000 level?
I can't speak in euro terms. The US Fed, I think, would prefer not to cut interest rates.
Mhm.
You have an economy in the United States that's functioning much better than many people thought it would, myself included,
Mhm.
in the face of an interest rate rise. And I think that the officials at the Fed believe, probably rightly, that they are the only thing that stands between the consumer and rampant US dollar inflation. There's no signs that Congress or the president will cut the growth of government. There is no sign that there will be a reduced deficit. there is no sign that we will be able to end quantitative easing in the face of lower interest rates. So I think that the Fed would like to keep the rates higher for longer. And I think until you see a Fed pivot, you will see a muted uptake for gold. I think that's a mistake on the part of U.S. consumers. And as I say, I'm specifically excluding the Eurozone from this because I don't live there. But in the U.S., U.S. investors and U.S. taxpayers look at the CPI, the Consumer Price Index, as the relevant index around inflation. And I don't think it is. I think it understates inflation. If you believe that the CPI is a measure of the deterioration of the purchasing power of the US dollar, then you believe that the US dollar is only depreciating at 2.6 or 2.7% compounded. I would argue that the CPI is a constructed index and not a measurement of the deterioration of the purchasing power of the dollar. For one thing, when looked at with regards to core inflation, they exclude food or fuel. Javier, what kind of a method is that in terms of its utility to you? Do you drive?
Yeah, I do.
Do you eat? You know?
Yeah.
The second thing, of course, is that the index is hedonistically adjusted, which means that irrespective of the price you paid, the big thinkers assign an arbitrary economic value to your home, your apartment, also to your computer, your technology. It's not an objective measure, it's a subjective measure. But the biggest problem with the CPI as a cost of living is it doesn't include tax. The biggest single household expense that Americans face is tax, and taxes have been rising inexorably. When I attempt to construct my own cost of living index around the basket of goods and services that my wife and I consume, what I learn is that the deterioration of my purchasing power, and by the way, I'm an old, fat, bald, rich guy. I don't buy much. But I see the purchasing power of my own savings declining at about 7% compounded. This reminds me, Javier, eerily, of the early part of the decade of the 70s. The hallmarks of inflation were everywhere, at the gas pump, in the housing market. But because we had lived through 2 decades of benign economic climate in the 50s and 60s, while people were aware of inflation, they didn't care about it. It wasn't really till about 1974 when people figured out how much poorer they were than they had been in 1970 that they began to be concerned about inflation. And my suspicion is that we have the same form of delayed reaction around American, at least, investors and consumers.
Yeah.
That could be crystallized by a rate cut. We had a rate cut in the US at the end of 1975, and that kicked off a tremendous romp in the gold price. It went from $100 US to $850 because the rate cut symbolized in people's mind the fact that the government cared more about other forms of economic measurement and less about inflation. And if that message gets crystallized again, then, and notice I said if, not when, if that message gets crystallized again, I think that the moment for precious metals will be sooner rather than later. Otherwise, I think it'll be later rather than sooner. But I do believe that this response is, in my own words, inevitable, only perhaps not imminent. If your measurement period for gold goes a little further back to the year 2000, I began adding to my own stores of physical precious metals in 1998, a little early. If you go back to 2000, in US dollar terms, the gold price has increased a little bit over 8% a year compounded, which is to say it has done its job in terms of safeguarding against inflation. I have, relative to my cash needs, a relatively large gold holding, and I own it for precisely that reason. I own it as a form of insurance to protect my family's purchasing power from inflation.
Yeah, something that a lot of people, a lot of listeners and investors miss is that the gold price is sometimes quoted in US dollar terms, but the gold market as natural resources is a global market. I usually put it in context of the SDRs, the International Monetary Fund, for a broader basket of currencies, and gold has breaking out already of the 2011 mark and the 2019. So I'm pretty optimistic about the gold price, and something that you refer as well is the correlation it has with real interest rates, because if CPI numbers, which is a measure of inflation, they put it surprising quite low, real rates are higher than what actually are, and the Fed puts a signal to the down pressure on the gold market. But I think that can reverse. Not imminent, and you said, but it's something that has a high probability of happen.
You know, it's instructive that we talk about gold right after uranium. In 2022, when it seemed to me like the uranium market was a coiled spring, because it hadn't moved, people didn't care.
Yeah.
Now that the uranium price is up fivefold, people care.
Yeah.
It was the same with the gold market in the 1970s. At the beginning of the decade, when gold was at $35 an ounce, people called it a barbarous relic.
They
didn't care at all. At the end of the decade, when it was at $800, people were all over it. Human nature is that a narrative isn't justified until the price moves. In other words, people don't want to drive looking out the windshield. They want to drive looking at the rearview mirror.
Yeah.
And that's a fairly dangerous technique.
Yeah. Why don't we follow the conversation with the little brother of gold that hasn't performed yet, which is silver? I mean, silver hasn't performed yet. 80% of the move happens at 80% of the time. What's your take on silver in 2024, Rick?
First of all, accurately forecasting silver supply and demand is very difficult. I've been trying to do it for 50 years with no success. In terms of supply, your listeners need to understand that most of the silver in the world comes from recycling or comes of a byproduct from copper, lead, zinc, or gold mines. So understanding silver supply has more to do with the copper prices and the zinc prices than it does with the silver price. Primary silver production is between 17 and 18% of total new supply. The second thing is that nobody knows how much silver is in existence, particularly in South Asia, where people have been storing their wealth in precious metals for 1,000 years. If you store your wealth in precious metals because you are afraid of your government and you're afraid of your government's currency, it makes perfect sense that you wouldn't report its existence to your enemy. And what that means is that forecasting supply too, in terms of above ground stocks, requires a knowledge, as an example, of drought or flood in India, which will determine whether people sell silver to feed their families. The demand side is tricky too, because a bunch of the demand is from Pakistan, India, Bangladesh, and Sri Lanka. So a knowledge of those domestic economies and when people have surpluses to invest is important. What we do know is this: industrial demand for silver, particularly around biomedical uses and photovoltaics and the solar industry, is increasing reasonably rapidly. We know too that in terms of investment demand for silver, prior silver bull markets have occurred after gold has broken out in US dollar terms. The initial move in the precious metals narrative is always gold, the fear buyer. When the momentum has been established by the gold market, there is a lag before silver follows. I suspect because of silver's lower unit value and its relative affordability to more people around the world, when silver begins to move, it moves further and faster. But in my experience, with the exception of the year 2019 and 2020, when you had what I suspect was almost a social media driven silver
Yes.
market, a very brief market. The gold market has to lead the silver market before the silver market moves. It's also worthy of note for your younger listeners, Javier, who haven't experienced prior markets, that the most dramatic upside moves over the last 50 years have occurred in the silver stocks. It would appear that the combined market capitalization of the legitimate silver mining business is so small that when the generalist money begins to move into that narrative, the market capitalizations literally can't contain the money. And the upside in these things is really ridiculous. The question that many of your younger listeners will be asking paradoxically is when? And I don't have an answer to that. It's odd that at age 71, I have become much more patient than I was when I was 30, despite the fact that I have less time on earth. It isn't because I wouldn't rather get paid now. It's because I know that these themes take years to play out. And I know that neither I nor anybody else on the planet will ever get it completely right.
Yeah, that's the market, right? At the end. Well, that was a really nice wrap up on silver. Another metal that marks a little bit with the economy is the copper, Dr. Copper.
Yeah.
Do you have any comments on that market? What is telling us right now?
Well, I need to say I love the copper business. I love it because I love big mines that last a long time. There are any number of copper mines around the world that make their shareholders in excess of $1 million a day. The scale and profitability of the copper business is such that if you are a mining investor, you have to focus somewhat on the copper business, almost irrespective of the cycle. Because it's just such a superb business. Despite the fact that it's a superb business, it's out of favor. We have not, I'm tempted to say as a species, humans have not invested as much money in the copper business over the last 30 years as they should have, anticipating the demand. And what that means is that almost no matter what we do, short of a depression, we are going to have a circumstance where we have a shortage of copper and where prices have to move to the upside. Now, if you have a severe recession, you can have reduced supply if you have reduced demand.
True.
And it doesn't move the price. But your listeners, who are probably young, affluent Europeans, and who probably think about copper demand in the context of electric vehicles and computers and stuff like that, I think it's important that you broaden your horizons to consider the fact that there is 1 billion people on the planet who have no access to primary electricity. 46% of Africans live without access to primary electricity. Another 2 billion people worldwide suffer from either unreliable or unaffordable electricity. And it is the electrification of the poorest third of humanity that will do the most to drive copper demand for the next 20 years. We've done a great job over the last 40 years of lifting the material living standards of the poorest of the poor on a global basis. Doesn't mean that there isn't more to do, but we need to look back over the last 40 years and see what we've done. This is a trend in motion. Javier, those people want to live like you do, and increasingly they're having access to the skills and the ability to generate utility that will allow them to do that. What stands between them and your living standard is increasingly copper.
Yeah.
Now, is this going to happen in 2 years or 3 years? I don't know. You tell me if we're going to have a recession. Absent a recession, we are going to have not severe, but certainly noticeable production shortfalls in copper within the 5-year time frame. And just like with uranium, the increase in the copper price will not in the near term generate an increase in supply. I have been part of trying to permit 3 different copper mines in your host country, Spain. And I can tell you that Spain, like the United States, often has a 20 to 25-year permitting process, which means if you were lucky enough to make a copper discovery in the Iberian copper belt, Iberian pyrite belt, and you were lucky enough to make that this month, it is likely that that mine could not impact copper supply for 2 to 3 decades.
Well, I mean, I'm 26 years old, so I can imagine how long it takes.
So
that.
when you look like me, the problem may be over.
Yeah, actually another, well, not metal, but natural resources that maybe you tell me, but maybe has some of the problems that copper has as well is oil, because since 2014, I believe it was the last capex cycle. Let's put it, when oil was at plus 100, it hasn't have a new production coming online, and all the spare capacity it's put in place on the Middle East, on the power of the OPEC to decide if they want to do it. What's your take on oil?
The oil business is a no-brainer. I'm not trying to say that every oil stock is going to go up, but investing in the oil industry is an IQ test. Sadly, most people fail. The big thinkers of the world, Joe Biden's, I use big thinkers paradoxically, Angela Merkel, those people, would have you believe that peak oil demand will occur in 2030. I don't know how they plan to fly their private jets to Davos if we don't have oil after 2030. Well, here's a statistic for you. Alternative energy is a very popular discussion in North America and in the Eurozone. Many people who spout this narrative, and by the way, I've invested in alternative energy for years. But many people who spout this narrative think that alternative forms of energy are going to replace hydrocarbons. They will be shocked to learn that over 40 years, we have invested over $5 trillion in alternative energies. And we've reduced the market share of hydrocarbons from a high of 82% all the way down to 81%. Peak oil demand will occur, I think, in 2065 to 2070. For the record, today is 2024, which suggests that you have a 4-decade runway. But the oil companies are priced as though the half-life of their economics is 2030. And that's absolutely silly. I'm not trying to say that you could buy any oil company in the world with impunity. But if you understand something about their balance sheets, something about the political circumstance that they exist in, the overall economics of the oil industry are fantastic. Despite that, perhaps because of the political headwinds, or perhaps too because so many oil companies around the world are state-controlled and state-sponsored, the oil industry is underinvesting about $1 billion a day, $365 billion a year, in sustaining capital investments. If you don't make the sustaining capital investments this year, your ability to produce 2 or 3 years from now begins to be constrained. So we've seen outfits like Pemex or YPF in Argentina, or importantly, PDVSA in Venezuela. We've seen systematic underinvestment, particularly by state-owned firms. And the consequence of that is that we've seen production and production capabilities at these state-owned firms decline by 70 and 80%. What this means paradoxically is that the politically inspired underspending in the oil and gas business keeps the oil price strong. What that means is that as an investor, you look for a company that's generating enough cash that it can both make sustaining capital investments while also being generous in its return to shareholders. This is, from my point of view, over the 5 to 10 year time frame, an absolute no-brainer theme.
Yeah, actually, the hard part is to find those companies that are generating cash. And for the last part of this interview, Rick, I actually wanted to propose you a game. I think it's going to be a lot of fun. In order to start the game, I would like you to tell people what the rankings on rule investment media that you offer for possible clients is, and what are the rules for those numbers in the rankings?
What you're referring to is a service that I offer for free and have offered for 8 years. Anyone who goes to my website, ruleinvestmentmedia.com, and lists their natural resource stocks, I personally will rank them 1 to 10. Now, the rankings are changing daily. It's important to note that the rankings are not static. And the rankings are very variable. It's important to note that whether or not a ranking is suitable to you really depends on who you are.
Right.
There are some companies that have a lot of risk, but they have a lot of reward. And I might, despite their risk, rank them fairly highly. There might be other companies that don't have a lot of growth built in, but they have an awful lot of stability, and they're generating a ton of free cash. Investors or speculators, pardon me, who are looking for 5 to 1 or 10 to 1 returns might themselves want to avoid those companies. But I really am all about the juxtaposition of risk to reward and the probabilities of both outcomes. So, as an example, a highly speculative offshore African explorer, African Energy, enjoys a 4 ranking despite its risk, because I see it as a potential 10 to 1 stock. While Exxon, which I consider to be the highest quality natural resource company in the world, also enjoys a 4 ranking. Mm-hmm. Exxon is highly unlikely to give somebody a 10 to 1 return, but they are certain to enjoy capital appreciation with high income in the interim. I need to say that we follow now 800 stocks, and it would be impossible for me to say to you that there wasn't bias, my own bias built in. Mm-hmm. I have become, over 71 years on Earth, inherently more conservative. I need to disclose to younger people who might be more speculatively inclined that, and this is going to sound very arrogant, I don't need 10 to 1 returns the way that I used to. Mm-hmm. And so increasingly, my bias as a 71-year-old is going to be against the rampant upside in speculation, mm-hmm. And reward much more the probability of return, the stability of the company's financial circumstance. The other thing that I need to say is that I view political risk very differently than most people. I don't put in place the political risk safeguards around emerging and frontier markets that some people may do. Mm-hmm. Not because I discount the political risk present in places like Russia or Kazakhstan or Bolivia or Congo, mm-hmm. but rather because I've experienced the risk in countries that are deemed to be riskless. If you made a discovery in Spain today of a nice volcanogenic massive sulfide copper deposit, and it took you 25 years to put it in production, the net present value that was there when you discovered the deposit would be gone.
Yeah.
But because the political risk occurred through the legislature, that is, through the process of law, politically inspired process of law, you view it as not being politically risky. Mm-hmm. Americans characteristically don't view the United States as a risky jurisdiction. But my worst experience with political risk occurred in what was then my home state, the People's Republic of California, mm-hmm. where we made a discovery, sadly, 7 miles on the wrong side of the California-Nevada line, and we spent 13 years getting permitted. during which period of time the gold price declined from $650 an ounce down to $300 an ounce, which is to say that the net present value of the deposit disappeared at the hand of the legislature. So I am much more willing to take political risk in uncertain jurisdictions, not because I like the jurisdictions, but rather because I believe that the most dangerous government is the government closest to you.
Okay, say that. Let's say that the number 1 is the best of the best, number 10 is the worst of the worst. So those are going to be the rules for the.
Okay. Sure. So let me give you a number 1. I think I've had 9 of them in all the years I've been ranking portfolios. A number 1 ranking means that I believe that the company would liquidate. You could sell it for cash on the open market for twice the current share price. Very rare to begin with.
Yep.
The company needs to have adequate financials so that it can survive to a catalyst. The catalyst needs to have the ability to double the company's value, not merely the share price, but the value within 18 months. And I need to see the possibility of a 10-fold return in the 5-year time frame. The last 10 that I gave out was, I forget the year. It was probably 10 years ago. It was Ivanhoe Mines.
You said the last one, right? The last number 1.
The last one, yeah. The company was selling for 63 Canadian cents a share. It had 97 Canadian cents a share in cash in it. In other words, it was selling at a discount to cash. It had the Platreef deposit in South Africa, where the Japanese government had bought 10% of the deposit for $200 million, suggesting that the 90% that Ivanhoe still owned was worth $1.8 billion, a substantial premium to their then market cap. It had Kapushi, which they had paid $160 million for, in excess of the whole market cap. And they had Kamoa-Kakula, then the most attractive new copper discovery in the world. I absolutely believed that the company was selling at a substantial discount. I considered that the company could liquidate at $2 a share. It was selling for 63 cents a share with 90-something cents a share in cash. I believed that continued drilling at Kamoa-Kakula would at least double the value, if not the price of the company over the 2-year time frame. That occurred. And I believe that having 3 world-class ore bodies in one company would make that company indispensable to a major. I noticed at that point in time that Zijin, what was then an aspiring Chinese miner, now the largest gold miner in the world, already had a toehold in Ivanhoe. And it occurred to me that either the Ivanhoe price went up or Zijin and CITIC took over the whole company. So the idea that I had a potential 10-bagger over the 5 to 10-year time frame was in place. All 3 of those were in place. In fact, the stock went from 63 Canadian cents, so 50 US cents, to now $13 US in the ensuing time. But remember, these ones are rare.
Yeah, they are. Actually, I remember you had a YouTube video back in, I don't know, it was 2016 or something like that, 2015, that you were ranking as one Ivanhoe Mines in I think it was a symposium or something like that. Very contracyclical. That's how people make money in the space, right? I want to know some companies. I know we don't have many time, but I cannot leave you go without asking one pick for gold. For example, there's a company that's giving away 23 million ounces pretty much for free with an uranium deposit as well, which is called Gold Mining Inc. We have covered a lot here in the channel. What's your rank for that company? And do you agree?
I have Gold Mining Inc. as a 5.
As a 5?
Yeah. The company has done fairly well in the market relative to other gold companies. Now, it's important to note that I have known Amir Adnani, who started that company, literally since he was a university student. He used to build websites for me. So I've known him for a very long time. I have a very high regard for him. He did a wonderful job in the doldrum period, acquiring gold assets that didn't make money at the then prevailing gold price, with the view in his mind that the gold price would increase. He didn't waste money putting them in production. It made no sense during periods of low prices to do that. You know, the big risk is that you put a mine in production when the price is low. When the price is high, you have a hole in the ground where your gold used to be, and you sold it all for low prices. He didn't do that. What will propel gold mining shares higher is now that Amir believes that we're in a period where the gold price will increase. He has put in place the team that will do the financial transactions to harvest the value that he purchased 10 years ago and 15 years ago. As I begin to see progress in monetizing the portfolio, then it is not unlikely that my ranking associated with the company goes up. But my ranking is all about net present value relative to market capitalization times the expectation of realizing that value. I need to see the process by which they monetize it. I need to see their access to capital. I need to see them optimize third-party transactions, senior secured construction facilities, royalty and streaming sales as an adjunct to equity. I need to see how they do what they say they're going to do.
Okay, and last but not least, another company from Amir, Uranium Royalty Corp, that is trading for, let's say, $70 enterprise value, which a lot of explorers are that have more market cap than that, with very low risk profile. And you could argue that the MacArthur and Cigar Lake royalties could pay for those $70 enterprise value. Do you have any opinion on that?
I agree with you completely. What holds down uranium royalty is paradoxically cash.
80% of the cash. The market
Yeah,
cap.
I mean, most people are assigning to other royalty companies net present value around royalties. With regards to uranium royalty, they are going to have to deploy some of that cash so that you can effectively model out the risk-adjusted net present value in the company. If you had asked me a year ago about uranium royalty, I would have said, you know what? Why would I pay a premium for cash? But now the market, I mean, the share price has fallen while the uranium price has increased. And so the relative attraction of uranium royalty, and they have done a reasonable job deploying some of that cash, it's becoming much more attractive than it had been.
Well, I think that's perfect for wrap it up. That it was 45 minutes. Thank you a lot, Rick, for all your knowledge, and bring it back to the Spanish community and the young generations.
I look forward to visiting your country next year. So perhaps the next time we can do this in person. In the interim, any of your listeners who care can go to Rural Investment Media, and I will rank on a no obligation, no cost their investment portfolio. Remember, too, we have an upcoming boot camp around exploration. These boot camps are 8-hour-long deep dives into various subjects. They cost you $99 US. You can attend fairly easily at home via your own computer. And by the way, unlike any other educational products I know in the investment space, if you aren't absolutely delighted with the value that you receive for $99, email me, and I'll give you a full gold-plated money-back guarantee.
Yeah, I will put the links under the description that I've received, because I think it has tremendous value. I've attended several of your conference, and I think you are not going to miss it out. Well, Rick, thank you so much for your time.
Javier, thank you very much for having me.